An investment strategy is a set of principles that guide investment decisions. Depending on your risk tolerance, investing style, long-term financial goals, you need to pick the right path. Today on the ET Money Show, we will be throwing light on strategic and tactical asset allocation. What are these two strategies and how they can minimize your risk and maximize your returns? To help you understand all of this, I have on board with me Feroz Aziz, Deputy CEO, Anandati Private Wealth Management. Feroz, good evening. Welcome to the show. So we've been discussing on a lot of investment strategies every time we do it, but then today specifically, I think for slightly experienced investors, I would like you to explain what is strategic and tactical asset allocation strategy. Starting off with strategic asset allocation, can a first-time investor adopt this strategy and begin the journey of financial planning or portfolio planning?
Kavita, strategic asset allocation is mandatory for each and every investor. Okay, what does it imply is, whatever is your goal, what is the strategy you're adopting to achieve that goal, and how mathematical is your decision? That mathematical decision, which has the highest chance to achieve your objective, will be called the strategic allocation. For example, if I have an objective of collecting 5 crores for my retirement, if that's the amount which I need, that's my objective. What is the strategy I will adopt to achieve that objective? The strategic allocation will have 3-4 things which are important. First is, what is the return I will need to achieve that objective? What is the numerical value of risk I am ready to take to achieve that objective? Third, what are the preferred vehicles I will use? Will I use mutual funds for equity? Will I use direct equity? Will I use portfolio management services? That's the third element of your strategy. Then comes your asset allocation. Then comes your timing and the product selection. So point I'm trying to make is, whenever you have an objective, you deciding a strategy to achieve that objective, which has the highest chance of achieving that objective, is called your strategic allocation. And the 3-4 things which I laid out are the decisions which you take when you decide your strategic allocation.
What other elements from an investor's point of view we need to be ready with? What's the kind of homework that's needed from the investor's side, in terms of their risk appetite, in terms of the understanding of investment instrument, their goals? What all is needed to begin this journey of strategic asset allocation?
Kavita, there are a few things which are needed. First is, whatever is your goal, what is the present value of that goal? For example, if I wish to retire after 10 years, what is the amount I need today if I wish to retire? If that amount is 2 crore rupees, if I had 2 crore rupees, if I'm going to be retiring today, that's the present value of the goal. That's the first thing which a person needs. If you want to get your child educated 10 years from now, what is the present value of that goal? That's first. Second, what is the time frame available for you to achieve that goal? That's the second input. Third is, what is the inflation which you should assume to arrive at the future value? The fourth is, what is the systematic investment you will have to do, is what the calculator can tell you. So what is the amount you need today? What is the time frame you have? What is the inflation number? And then you will know whether you need 20,000 rupees a month, 40,000 rupees a month, or 2,000 rupees a month. These are the 3 inputs an investor should have to arrive at a strategic allocation.
And does this type of asset allocation is flexible in terms of the changes in your goals, in terms of your income that's flowing in for your investments? Is it a flexible type of an approach?
See, there is, no, this is not so flexible. That's why you have the tactical allocation. So point 1, the answer is, it is more rigid. Strategic allocations are more long-termish. You've decided that you want to collect money for the long term. Your asset allocation, let's assume you have decided 80 into equity, 20 into debt. That's going to be more rigid. That's when the other tactical allocation comes to help you maneuver through the short-term differences which are going to happen in the journey, right? So strategic allocation has a big advantage of helping you realign the portfolio based on the return and risk, which is there. Now, if you have decided 70-30, if the portfolio sometimes becomes 80-20, it helps you rebalance it back to 70-30. It's a very, very strong tool to help you come back on the path.
How different is tactical asset allocation?
So, Kavita, tactical allocation is more tactical in nature, as the name suggests. Let's assume if the market falls 20%, now which it has, every year market falls 10 to 15%. So, if there is a fall of greater than 20%, I personally adopt a tactic of increasing equity by 10%. So now let me illustrate with an illustration. I'll tell you the tactic which I use, one of them. The highest Nifty level the market has seen is 15,477. If the market fell to 15,300, which it did actually incidentally in the month of June, I would move 10% of my debt money into equity momentarily. That's called a tactical extra allocation to equity. It pays off several times when I've been doing this over the last decade. That's one such example of a tactic you use depending on what opportunities God has to give you during the period of your investing.
What kind of an investor can actually make use of a strategic and tactical asset allocation in their portfolio at different point in times only maybe, but then can these two strategies be utilized for one financial portfolio?
Yes, Kavita. Both can be. Strategic is mandatory. Tactical is optional. Strategic is very important because that's going to decide your return and your wealth values over long periods of time. If you don't get that right, it is difficult for you to achieve your goals with adequate satisfaction. So strategic allocation is mandatory for all of us. Tactical is nothing but some degree of agility, some degree of opportunistic behavior on your strategic allocation. One such example was market corrections. You increase your equity allocation. That could be one tactic. Second, now today what has happened is interest rates have gone up. And government bonds itself are giving you 6.5% post-tax if bought in the form of an index fund. So will I move all my corporate bonds to GSEC funds, which are hold to maturity? The answer is yes. So that's another tactic. So tactic is optional, strategic is mandatory.
I think we should move on to our next bit of the show, which is investor and viewer queries. So, Feroz, we have a query from Rajiv Sharma. He's based out of Dubai, UAE. He's 41 years old and he's married. He has a son. He has a separate corpus for his retirement, which includes a lot of things that he's mentioned. I think you also have his portfolio on you. He has mutual funds and he's got money in US equities, fixed deposit, and separate funds for his son's education. He wants to know how much corpus he'll have to invest to achieve his defined goals. Currently, he has no financial obligations such as a housing or education loan, etc. So, what according to you can be the road ahead for his goals? We don't have a definite goal figure in terms of details, but whatever is being asked and whatever you can gather with respect to giving a financial plan to him.
Yes, so the Rajiv should firstly ascertain what is the amount he needs in 2039 for retirement. To our mind, if he has a 20 crore corpus, that will be a sizable corpus for him to retire, given his current savings already. That's point one. For his son's education, he needs about 2 crore rupees in 2032, which is close to 10 years from now. Investing close to 1 lakh rupees in the retirement bucket and 55,000 rupees for education bucket. These two goals with 1 lakh and 55,000 can be achieved. So 1 lakh rupees a month can help him achieve with his current investments plus this 1 lakh rupee can get him to 20 crores at retirement, plus also another 55,000 for the education bucket can get him to close to about the amount needed, which is 2 crores for 2032 for his son's education. The asset allocation he should adopt is 80 into equity, 20 into debt, because both his goals are reasonably long term. The shorter goal itself is 10 years and the other one is close to 17 years. So I would suggest 80% going into equity and 20% going into debt. The reason being, we analyzed 26 funds in India which have finished 25 years of existence. If anyone were to invest for 10 years in the worst fund, he won't lose money. So point being made here is if you have 10 years, equity risk on capital becomes negligible or nil. So that's why 80% goes into equity, Kavita. So that's the suggestion for him, unless he has further questions as well.
All right, we move on to our next query. This is from Shrikant Subramaniam, and he's 50 years old and he's working as a MNC manager. Annual income is around 12 lakhs, and he's got SIP in the following funds. He's got Axis Focus 25, IDFC Banking and PSU Debt Fund, ICICI Prudential Corporate Bond, Mira Asset NYC FAN ETF, and he's just received 50 lakh after a sale of property, which he wants to invest further. He also has a daughter and he's a single parent, and he has to take care of his parents also financially. So where should he invest the 50 lakh that he's got from a sale of a property? And I guess he's not asked about his retirement, but then probably what could be the amount if one wants to have a retirement corpus from the existing investment?
Kavita, if you just look at the current investments, which is 4 different funds, which is close to 10,000 rupees plus the 50 lakh rupees, assuming that's the post-tax amount after the sale of property, we'll come to the taxation of the sale of property in a bit. And if there's 12% return forward-looking for the next 10 years, he can accumulate close to 2 crore rupees in the next 10 years. With his 50 lakhs plus 10,000 rupees on a monthly basis, which he can currently afford. I'm sure he can scale it up. So if he aspires to have 2.5-3 crores in the next 10 years, that will be a great target for him. Coming back to the question of he having sold a property, whenever you sell a property, it's very important to calculate your indexation values and file taxes as per the indexed values. If it is an ancestral property, you get indexation from 2000. So it's very important, Mr. Subramaniam, to consult a CA and see what is the tax optimization possible. There's also Section 54, which allows you to reinvest in property to a certain extent, to the extent of the capital gain, to make that component tax-free. So after you've decided that there is no reinvestment needed to mitigate tax liabilities, which Section 54 permits you to legitimately and legally, examine indexation and 54 and its relevance for your specific property is what I would suggest. Coming to the schemes which you currently own, I would say most of the schemes need a change because you have one corporate bond fund. I would definitely not subscribe to a corporate bond fund currently because the government papers itself are giving you a post-tax return of 6.3, 6.4. If you buy an index fund of government paper of 2027, buying corporate paper is only desired when there is an extra return which is substantive, which is more than the government of India. That's not the situation today. So don't be in a corporate bond fund, one. Banking and PSU debt fund also is something which you should not have in your portfolio. You're at the age of 50, you have 10-15 years. These both are debt funds. Mirai Asset NYSC FANG, which is nothing but a technology-based global fund. Firstly, you're going global, and that too technology-based sector fund, which is not a great idea. Axis Focus 25 is again a focused fund. So all your 4 funds, you don't have a core portfolio, you don't have a strategic allocation, which we spoke about in the first segment. So please go back and see the first segment. Having no large cap fund in India, no flexi cap, no small cap, no mid cap, and having a technology-based global fund is not a great start. That's the peripheral part of the portfolio that can't ever form core portion of your portfolio. So all 4 funds require a rethink. The funds which you can choose from, which are the 5 different categories which I will articulate for you. Franklin India Blue Chip, which is a large cap fund. HDFC Flexi Cap, which as the name suggests is a flexi cap fund. Kotak Emerging Equity, which is a mid cap fund. SBI Contra, which is a contrarian bet fund. And DSP Equity Opportunity, which is a large and mid cap. So I've given you 5 different funds from 5 different categories, 5 different asset management companies, which can be a core portfolio. If you're going to have this 50 lakhs invested, it deserves and merits a full-fledged review and a rethink on the strategy which you're currently on.
All right, so a lot of changes for Shrikant, and rightly pointed out by you, one needs to have a co-portfolio so that later on strategies can be built upon that. That will be all, Feroz, for today. Thank you so much for being a part of the show and explaining our viewers different concepts of financial planning. And with that, it's a wrap. Thank you so much for watching the show today. But then as we end the show, there'll be a number, a WhatsApp number and an email ID that will be flashed on the screen. And you've got to note these things down and send us your financial queries because that'll be solved by our top experts on the show. Thank you so much. Goodbye.